almost wondering if we should actually open the bar now. On behalf of everyone in this room today, thank you very much for your time. And now for our final keynote of MFA Outlook 2019. As modern-day markets continue to challenge traditional Fed policies, there is perhaps no better time to hear from the New York Federal Reserve President John Williams, who is here today to share his perspectives on the repo market, the business cycle, and evolving monetary policy, and more. President John Williams became the 11th President and CEO of the Federal Reserve Bank of New York in June 2018. He serves as Vice Chairman and a permanent member of the Federal Open Market Committee. Before joining the New York Fed, he was the President and CEO of the Federal Reserve Bank of San Francisco. President Williams will join us for a closing address, which will then be followed by a fireside keynote chat with Kim Liu, CIO of the Carnegie Corporation of New York. Please join me in welcoming President Williams for the first portion of this session.
New York, New York, these vagabond shoes are longing to stray right through the very heart of it.
Well, good afternoon, everyone. Now, I understand you've had a very a good day of discussions and hours of discussions of complex and technical material. And normally, when I give the closing remarks at the end of the day, I try to offer some light relief. But alas, I'm not going to be doing that this afternoon. The topic I'm going to address this afternoon is both complex and technical. It's the recent turmoil that we've seen in repo markets, and it's the Fed's actions to address that. I'm going to start by laying out the Fed's operating framework for carrying out monetary policy, and this will take me into some aspects of the so-called plumbing of the financial system. And that may seem like an esoteric topic to some, but it's actually one of critical importance, so please bear with me. I then go to the money market turmoil that we experienced about a month ago that led to the New York Fed to conduct open market operations to stabilize short-term rates. And I'll conclude by describing the path forward as laid out by the Fed announcements this past Friday. Now, before I go any further, I have to give the usual disclaimer that everything I say reflects my own views and not necessarily anyone else in the Federal Reserve System or the Federal Open Market Committee. So as a prelude, it's worthwhile to step back and remember how all this connects to the Fed's overarching monetary policy goals. The Federal Reserve has two goals set by Congress: maximum employment and price stability. The main way we achieve these goals is by controlling the federal funds rate, and that's the interest rate at which banks lend each other money overnight in the form of unsecured loans. And this rate, in turn, affects overall financial conditions and thereby the wider economy. Now, at each of our meetings, the Federal Open Market Committee, or FOMC, decides on the target range for the federal funds rate, which currently stands at 1 3/4 to 2%. But how does all this work? That is, what keeps the federal funds rate within the target range? And the Fed has an operational framework in place designed to keep interest rates where the FOMC wants them. And we call this the ample reserves regime. So back in January of this year, the FOMC communicated its intention to continue to implement monetary policy according to this regime. And a key benefit of this approach is it's a simple, effective way of controlling the federal funds rate and thereby influencing other short-term interest rates. And the ample reserves framework has three elements that are designed to maintain the federal funds rate within the target range. So the first, not surprisingly, is supplying an amount of reserves that banks hold at the Federal Reserve that is ample. And by that we mean that the supply of reserves is adequate to efficiently and effectively implement monetary policy. So let me define those words. So here, efficient means that the level of reserves is not excessive relative to what's needed to be effective. And by effective, we mean that the typical temporary movements in the demand or supply of reserves don't cause large changes in the federal funds rate without the active management of reserves. So I'll come back to this challenge of knowing what constitutes ample reserves a bit later. Now, the second element of our framework consists of the interest rates that the Fed itself sets and that thereby influence the federal funds rate. Now, these administered rates, as we call them, include the interest rate that we pay on reserves held at the Fed and overnight reverse repo rate that the Fed pays to a wider set of money market participants on similar risk-free overnight investments. Now, so these first two elements, that's the ample quantity of reserves, and these administered interest rates are meant to do the lion's share of the work to keep the federal funds rate within the target range. But there may be relatively infrequent situations when these two elements are not enough to keep the federal funds rate within the range. Therefore, a third element is a directive from the FOMC to the New York Fed's open market trading desk, the desk, to conduct open market operations as needed, again, to keep the funds rate within the range. For example, through repurchase agreements of Treasury and agency securities, the Fed can temporarily increase the amount of reserves in the system. Now, to support the economy in the aftermath of the financial crisis, the FOMC increased its long-term securities holdings dramatically, and this led to a similarly large increase in the amount of reserves, which peaked at $2.8 trillion back in 2014. Well, subsequently, the growth in non-reserve liabilities, such as currency, and reductions in the Fed securities holdings have caused reserve levels to decline. And as the level of reserves have come down, we stepped up our monitoring of the effective reserve levels on interest rates. The level of reserves consistent with ample is inherently highly uncertain, so we've been actively looking for signs that reserves might be getting scarce. Along with in-depth analysis of conditions in money markets, we've conducted surveys of banks and other outreach to market participants to understand the factors that influence the demand for reserves. And to smooth the transition to a level of reserves consistent with our framework, the FOMC announced a slowing of the pace of reduction in securities holdings back in March, its March meeting, and we stopped it outright back in July. Now, based on a variety of metrics and information, the supply of reserves appeared ample during the summer and into early September. The funds rate traded well within the target range, and money markets functioned well. But with the stage set, I'll now turn to conditions over the past month and the Fed's actions. So conditions in money markets became highly volatile a month ago. Secured and unsecured rates moved higher, and they became much more disparate on Monday, September 16th, and this intensified the following day. Now, we and many commentators had expected a number of factors, including corporate tax payments and the settlement of newly issued Treasury securities, to put some upward pressure on short-term rates. However, the size of the reaction in repo rates, the spillover to the federal funds market, and the emergence of strains in market functioning were well outside the range of recent experience. In response to the simultaneous increase and widening dispersion in repo rates and the federal funds rate, on the morning of Tuesday, September 17th, the Fed conducted the first non-test repo operation in many years, followed by daily operations after that. These actions have the desired effect of reducing strains in money markets, narrowing the dispersion of rates, and fostering conditions in money markets to keep the federal funds rate within the target range. And to ensure that the federal funds rate remained within the range going forward, we've announced daily, overnight, and regular term repo operations, which continue to this day. Now, our open market operations have succeeded at keeping the federal funds rate within the range and have stabilized conditions in short-term funding markets. But at the same time, recent experience has provided important lessons for the successful operation of our ample reserves framework. A confluence of events contributed to the volatility in money markets about a month ago, but one telling observation is that when increases in the Fed's non-reserve liabilities caused the level of reserves to fall well below those that prevailed in summer and in early September, that's when we saw strains in money markets emerge. And when the prior level of reserves was quickly restored through our temporary open market operations, but then we saw more normal interest rates and market functioning return. So in light of these events, we've learned that the ample reserves framework has worked smoothly with a level of reserves at least as large as we saw during the summer and early September. Although temporary open market operations are doing the trick for the time being, anticipated increases in non-reserve liabilities would cause reserves to decline in coming months without further actions. So based on these considerations, last Friday, the FOMC announced that the Fed will be purchasing U.S. Treasury bills at least into the second quarter of next year. Specifically, the desk announced an initial pace of purchases of $60 billion, initial monthly pace of purchases of $60 billion. These permanent purchases will, over time, bring the underlying level of reserves, by which I mean absent temporary open market operations, to a level consistent with the ample reserves framework on a sustained basis. In concert with these purchases, the FOMC has announced that the desk will continue temporary overnight and term open market operations at least through January of next year. This combination of permanent Treasury bill purchases and ongoing temporary open market operations is designed to provide effective control of the federal funds rate over the next several months. Now, I should emphasize that all of these actions are aimed at the implementation of monetary policy and do not in any way represent a change of the stance of monetary policy. The goal is simply to make sure that the federal funds rate stays within the target range that's set by the FOMC. Now, as we move forward, we'll continue to learn about the demand for reserves and other Federal Reserve liabilities. We'll learn about market functioning and may adjust the specifics of this plan as appropriate to achieve our goals. Now, that's a lot on monetary policy, interest rates, repos, and reserves. But before I close, I'd like to emphasize an important point about a particularly important repo benchmark rate, and that's called the Secured Overnight Financing Rate, or SOFR. SOFR is the reference rate that the Alternative Reference Rates Committee, the ARC, has selected as the preferred replacement for LIBOR. At the same time that we saw turmoil in the repo market, we saw a temporary spike in SOFR. As market participants make preparations to transition away from LIBOR, they're understandably watching SOFR very closely. So there are a few things I'd like to highlight with respect to SOFR. First, a temporary spike is not surprising, given that SOFR reflects real-world transactions. Second, the very fact that we saw a spike in SOFR is an indication that it's a representative rate of its underlying market. It's based on actual transactions rather than judgment like LIBOR. And that's one of the reasons that makes SOFR robust. And third and final is that in the vast majority of use cases, the relevant metric for SOFR is an average over time. Focusing on overnight SOFR on a particular day isn't particularly useful in this context, as financial contracts will generally refer to an average of SOFR over many weeks or months. So my message to all of you is, don't let last month's temporary spike in SOFR or the hope for a creation of some other replacement reference rate become an excuse for delaying your transition from LIBOR. I've said it before, and I'll say it again. Like death and taxes, the end of LIBOR is unavoidable, and we must all do what it takes to prepare for a LIBOR-less future. And the existence of LIBOR is only guaranteed now for another 807 days. So I've talked about a lot of important issues this afternoon, and I greatly appreciate your attention. The events I've described are an apt reminder of the importance of well-functioning financial markets and the vital role that the Federal Reserve plays in providing liquidity. It's also a demonstration of our ability to act swiftly and effectively to execute our monetary policy implementation goals, keep the federal funds rate within the target range. Thank you very much.
Thank you very much, President Williams. We appreciate your comments today. I would now like to invite Kim Liu to the stage for a fireside chat with President Williams. Kim Liu is the Vice President and Chief Investment Officer of Carnegie Corporation of New York, a private foundation established in 1911 by Andrew Carnegie. The $3.5 billion portfolio is global in scope and diversified by asset class and strategy. Prior to joining Carnegie, Ms. Liu spent 13 years at the Ford Foundation. Please join me in welcoming Kim and President Williams for their fireside chat.
New York, New York, these vagabond shoes are longing to stray.
So clearly, we got this music because both of our jobs have "of New York" in the title. So, President Williams, thank you for your comments, and thank you for spending a little time with us. Your presentation introduced a lot of concepts around interest rates, and I hope that we get a chance to drill down on some of that. But before then, I was hoping that we could spend a little time talking about economic cycles, particularly now and during this period of uncertainty and unpredictability. Over the course of the day, we spent a lot of time talking about geopolitics, technology. We've talked about climate, counterintelligence, global politics, disruptions, retirement. And I know that these are not your specific areas of focus, but I'd love to hear how you guys at the FOMC incorporate this into your thinking. We as long-term investors have to think not just about what's happening now, but how things are changing in the future. And a lot of these things are not just changing the now, but shifting and reshaping economic cycles. So I'd love to hear how you think about that both in the short term and the long term.
Right, and these are great questions and topics that we are very focused on at the Federal Reserve. A couple of things I just stipulate. One is we are in an economy, and a global economy that's constantly changing. I've been in the Fed 25 years now, and the economy today, how it behaves, the composition of our economy and our labor force has changed dramatically in those 25 years. China's role in the global economy, obviously, a huge change in that. So if you're going to be a policymaker or macroeconomist and think about these issues, you need to both recognize that the world is changing and changing in unpredictable ways. And second is you have to be comfortable with ambiguity. A changing world is one that's hard to have absolute answers to. People often ask me, what's the effect of tariffs on inflation? What's the effects of oil prices on GDP? Well, those are, we have models, we have analysis, but you have to understand in a changing economy, the answers change, and that means greater uncertainty. So, for example, I'll give you, the oil prices. The change in oil prices today on the U.S. economy is very different from 25 years ago because obviously we're a huge producer of oil today, and that affects jobs in the drilling and transportation industries in ways that were very different than when we were mostly an oil importer.
Yeah. So that you've touched upon two things that I'd like to drill down on, because one, the mere fact that things are different. I know that you believe strongly in data and the importance of data, and you use it to drive decisions. So how do you deal with the lag that's introduced by data? How do you deal with the fact that the data may not tell you what is going to be the outcome given some of the things you just said about the market is very different now than it was when some of that data happened. And so when you think about those things, and so my other question that was raised by what you said is China, and specifically, how do you think about incorporating data about China and whether it's reliable and you can count on it, and how do you feel about the competence of the banking system there and the information you know about that?
Right. Well, when you think about monetary policy decisions, the evidence is it takes a year or two for any monetary policy action that we make to have its full effect in the economy. So you're always thinking, where is the economy going to be, not next week or next month, but where is it going to be in late 2020, 2021, 2022? And so you're always thinking about not where the economy is today, but where it's likely to head, and obviously the range of uncertainty around that. And so when it comes to thinking about data, I prefer to define it much more broadly than just GDP and the unemployment rate and inflation, but all the information we get, from markets, from the financial data we get more generally about mortgages and consumer borrowing and all of that, the information we get from our contacts that we talk to around the country in the various 12 Federal Reserve banks, where we're regularly talking to business people, community leaders, and others, learning asking them questions and learning from that. So it's not just looking at the unemployment rate from last month and saying, well, that's all I've got. You're constantly looking at all the official data, the financial market data, and then the qualitative data that we get from talking to people and surveys. So all of that information is to try to shape both kind of what you view as where the economy is going, but also the assessment of where the uncertainties and risks are. So specifically on China, we do have a lot of analysis that we've done at the Fed around how, and others have done this as well, about how accurate the GDP statistics or others are. And this is a great example of researchers being very creative, where you look at other metrics for economic activity, things that, like you're looking at the exports of other countries into China, or imports, data collected by other countries, and data on the hard, more hard numbers like electricity and things like that. So there's a lot of analysis that you're able to look at a lot of different indicators and vector in, if you will, to what's going on in China's economy, even if maybe there's some dispute about exactly is that latest GDP number the most accurate. And so we are able and do this regularly to make sure that we're looking at a range of facts and figures to come to our conclusions. But I still go back to this previous point about you have to be comfortable with there's uncertainty. If you ask me, the unemployment rate is 3.5%. I can even say it's 3.52%. But the thing is, it's a one survey, one data point, and you have to really take into account all the information you're getting.
Is there any one new source of data that I would be surprised that you use?
Well, I think that the biggest change, I'm a macroeconomist, so I'm always looking at the big picture, GDP and things. I think that the data that we use is most interesting these days is actually the micro data, where again you can get down to individual mortgages, individual households and businesses, and really drill into very specific questions with an enormous amount of data. When I've been post-World War II data, you have about 50, 60 years of good GDP data, but when you look at the U.S. economy, you could have hundreds of thousands or even literally hundreds of millions of data points that you can do. So a lot of the really creative analysis is taking this microdata and comparing what's happening either in different cities or different parts of the country or just across zip codes, and really answering the questions kind of granularly instead of trying to look at the aggregate data.
So in the environment that we're existing in right now, do you think that monetary policy is enough to stimulate an ailing economy if we should have one again? Or do you think we'd have to go to fiscal stimulus? And given where interest rates are now and given all the actions that's been taken so far, do you think that we'd have to go to some other tools or mechanisms?
So in a potential future downturn,
yeah.
Right? You know, monetary policymakers, not only in the Fed but around the world, I meet with my colleagues regularly, we all love the idea that fiscal policy will come in and help support the economy during a downturn. That's having fiscal and monetary policy working in the same direction to help the economy is obviously better than just one or the other. So yes, you want fiscal policy to support the economy. And actually, in the U.S., we've tended to see in the last several recessions fiscal stimulus during the middle of a downturn. So that's typical. That's a typical pattern. Do we need to have fiscal policy? Can monetary policy? Do we have the adequate tools with monetary policy alone? I would say the answer is yes to that. It is true that interest rates are low, so if we were to have a recession in the future, we don't have, at least based on where we are today, a lot of room to cut short-term interest rates. But of course, after the financial crisis and the Great Recession, the Fed would use other policies, some to indicate where we thought interest rates, they were going to keep interest rates low for a very long time, they called that forward guidance, also using asset purchases to affect longer-term interest rates. And so we definitely have a lot of tools in our toolkit to address a downturn in the future, depending on the circumstances. And I think importantly, we, the policymakers and the economists at the Fed, have learned a lot about the effectiveness of those tools and how to leverage them as well as possible in the future. So we've seen, for example, back into 2008 through 2011, there was a lot of concern out there that quantitative easing or asset purchases would create high inflation. And that was one of the probably trade-offs people were thinking about. Well, now we saw that didn't happen, and now we could think in the future that perhaps some of those worries about these untested tools, well, we know a lot more about their effectiveness and could use them perhaps more quickly and more powerfully.
So that, you raised that in specifically the point about inflation, and I know a lot of people's views on it, or I've read some views on it that said that just the structure of our economy is just so different than it was before, that we're less dependent on interest rate sensitive industries like manufacturing and industrials, and so the idea behind it being that the interest rate changes is just going to be less impactful. Yeah. Well, and so inflation will be different. How do you think about that?
Yeah, absolutely. This goes back to your first question, which is the world has changed. The world's changed pretty dramatically. Inflation dynamics have changed. Inflation during the Great Recession, despite an unemployment rate of 10%, really only fell to about 1%, from about 2 to 1, a very small change. And we've seen inflation running between 1 and 2% ever since. So we've just not seen the big swings in inflation that we, or at least some of us, experienced back in the 1960s and 70s and 80s. And I think part of that's been good monetary policy, keeping inflation low and stable. That's built into people's expectations. But I also think the structural changes in our economy. It is a much more service-oriented economy. It's a much more global economy. Even though our trade percentages relative to GDP are still relatively modest compared to other countries, the ability of competitors around the world to quickly compete, especially on goods, but increasingly on services, is, I think, a big factor affecting inflationary pressure. So, back in the old days, in the 60s, if the economy was running too hot, immediately inflation would start picking up Today, if the economy is running hot, we obviously can import goods and services from abroad without creating as much inflationary pressures. Now, I still believe, as Milton Friedman taught us, that if you run monetary policy too loose, or you run the economy too hot for too long, eventually inflation will pick up. But it doesn't react nearly as strongly or as persistently as we saw back in decades ago.
So given what you just said, are you more concerned, or did you spend more time thinking about the trade war, than you might have otherwise thought you would be?
Sure. I mean, we are always focused on our dual mandate goals. That's maximum employment and price stability. You think about the trade issues and the geopolitical risks. You mentioned those as well. How those affect the economy. Obviously, monetary policy does not, can't offset or change trade or geopolitical issues. It's really the question of how does the environment that we're operating in affect the economy in terms of jobs, in terms of inflation, and how can monetary policy, be used to keep the economy at a full strength, keep inflation near our 2% goal. So when I think of the trade issues, for example, we do a lot of analysis and research that highlights the direct effects of tariffs on trade, on inflation, and the effects on the economy, and we incorporate that into our forecasts. But there's a second factor, which I think is far more important, and researchers have been highlighting actually for a number of years, is this uncertainty. If the tariffs are known and in place, obviously businesses will adapt and their business models will evolve. But it's the uncertainty about adapt and their business models will evolve. But it's the uncertainty about whether it's geopolitical risk or trade policy